Dennis, you heard Kevin talk a little bit about all the different technologies that people use in order to try to find a job or make their resumes more presentable. And, of course, this kind of segues back to investing a little bit because there's so much technology that's involved in investing. I mean, go watch CNBC for a half hour and you'll see 30 different technologies you can purchase.
Right. Well, look, there's no doubt that technology has changed the world in a lot of ways. I mean, as Kevin was saying, a few years ago, LinkedIn didn't exist, and one of the comments I was worried about when he was talking about Facebook was, you got to make sure what's on your Facebook page is presentable to people. There's a lot of junk on these Facebook pages, but it has made it easier to find out about a person, but it's also made it more difficult to really get to know the person. And I think technology, you've got to view it. It has made things faster. It allows us to process much more data. It allows us to communicate, but it doesn't necessarily provide a solution in and of itself. And this is particularly true in investment. Having a faster quote doesn't make you any better at picking the stock. Having a big number crunching machine doesn't make you any better. If that were the way, if crunching numbers on stocks was the way to wealth, then the entire S&P 500, Forbes 400 would be made up of accountants.
Texas Instruments.
Texas Instruments, right. So it doesn't happen. So technology can really become a problem. And this idea that you can use technological and math and advanced algebra and all the rest of the stuff to predict and to make the market work, it doesn't work. What it does is it disguises the risk and shifts it to someplace else. It's still going to get you. At some point, the risk is the same. The risk of investing in the market today, the basic risks of investing in the market today are exactly the same as they were during the time of the South Sea Bubble in the 18th century in England. It's the biggest risk to investment lies between people's ears. It's not technology. It's not news. It's not bad management. It's our inability as human beings to know ourselves and to be true to what we know about ourselves and to stay on a course that suits us and not be dragged off to somebody else's course.
I think that's a real key point. And also it tends to resonate with what you said earlier about people aren't even necessarily investing in companies anymore. They're investing to make money.
Right.
Because when people lose a lot of money, I mean, even back in back in 2008 or any of the big crashes, it's not like 70% of the major companies went out of business, or that all of a sudden their machinery was worth 70% less, or their output was even out 70% less. It was simply this intrinsic value that people held,
right, rather
than the actual output of the company.
Well, one of my favorite stories was a few years ago. Intel reported quarterly earnings, and they had doubled their earnings from the previous year. Revenues were up. The stock dropped almost 18%.
Same thing just happened with Apple.
Well, some analysts said, well, yeah, they doubled it, but they should have done 125%, and they should have done this. Well, how many of us wouldn't like to make twice as much money this year as we were making last year? That's the fact, is they make twice as much money. The fact that some 26-year-old MBA from someplace who's never worked a day in his life at a real job says that Intel doesn't make as much money because its gross margins were down half a percent, is silly. Why put your wealth on people who probably don't know anything more about this than you do?
Which really makes it speculation, not investing, doesn't it?
It is speculation. Speculation's all about making money in the short term. Investing's making money in the long term. It's much less risky to invest than it is to speculate.